Today, I want to show you exactly how much money we make, how much we spend, and how much profit we make by showing you our actual accounts. And what I'm hoping is it will teach you how to exactly understand financial statements. And it's actually kind of fun. Now, I used to hear about financial statements and I'd look at one and it just looked like numbers on a page. And it was only through running my business, TCLA, that I've learned how important it is. It gives me this very objective sense of how's the business doing? And I now run all of my decisions through this financial model that we have. So this is the profit and loss statement. That's also known as the income statement. And a P&L, profit and loss statement, is one of 3 financial statements. The other 2 you should be aware of is the balance sheet and the cash flow statement. We'll cover those later. So these are different to the financial model I mentioned earlier where I make my decisions. A financial model is about projecting the future. So I'll have different scenarios and I'll run it through this model and it will tell us what does the numbers look like in the future. Whereas the 3 financial statements are about showing you how the business is actually performing, what it owns and owes, and how much cash is moving through it. Now, I like the P&L the most because it shows how my business has performed over a period of time. For me, it's the most useful picture of how well is my business actually doing? How much money am I making? What are my costs? And how much profit is left over? These days, I update my own P&L every week, and then we have our accountants who file these profit and loss accounts and financial statements every year, which companies must do as a legal requirement under the Companies Act. Now, what's great is that actually, if a company is over a certain size, you can actually go to Companies House, check on their filing history and see their accounts, and then you can learn about the finances of that business. Now, I should say at this point that the P&L is what we call a lagging indicator. What that means is I wouldn't rely on this to make financial decisions about the business. It tells me after the fact how my business has done. So it's very helpful in analyzing past performance. And you can have different time periods, right? So for us as a company, our financial year runs from the 1st of May to the 31st of April. You could have a P&L for a month or a quarter or a year. For our purposes, I'm going to do the 24 to 25 financial year, and I'll take you through the P&L that was produced by our accountants. So let's start at the top. So this at the top of the financial statement, I see turnover. And for our purposes, think of that as another word for revenue. It refers to the money we made from sales. Revenue is what most people usually think about when they think of the success of a business. It's often what people say. So it's called a top line metric because it literally sits at the top of the P&L. And it tells us how much money did we make? The kind of thing I often look at is, are you making more than you did previously? Now, the importance of revenue as a metric really kind of depends on your industry. Say if you're a tech company funded by a lot of venture-backed money, your goal is to grow as much as possible, for example, then revenue could be a good metric for how big is this company, as opposed to, say, profitability, which they may not be caring about at this stage. Amazon famously didn't post a profit for so many years, but when it needed to, it did.
Well, we are a famously unprofitable company.
But if you're not one of those types of companies, that's also really important. So say you could make 100 million in revenue. Sounds amazing if you tell people, but if your costs are 200 million pounds, your business isn't healthy. And some businesses like coffee shops or restaurants, they really feel this pressure. We say their margins are often pretty tight because yes, they may make a lot of money, but their costs are very high. So if I look at turnover on the P&L, what we're seeing here is different categories of where the revenue is coming from. So we have application revenue, for example, which is when we review applications, how much income does that make? Or mock interview revenue. We also work with law firms, so that's partnership revenue. And then we have subscription revenue. Now, all of these, you can add them up, and that's how you get to the total revenue of the business. So for 24 to 25, our total turnover was £451,675.35. Now, one final point you should know is that companies can sometimes do all sorts of dodgy things to massage their numbers. I'll give you an example. So in a P&L, revenue is not always the same as cash in the bank. So business could sell something today and they get paid for it later, but they actually record that now, even though the cash hasn't arrived yet. Now, a famous example of a company taking advantage of this is Enron. So they would have these huge 10+ year contracts. And they'd be like, okay, this contract is probably going to make 100 million in profit over its lifetime. So they would book that now, and the accounts look strong, even if many of those deals didn't actually pan out.
But the SEC is now investigating Enron's accounting procedures after the company admitted it inflated earnings by more than $500 million.
Okay, so we've done revenue. We go to the next item in the P&L called cost of sales. So cost of sales are the costs that are directly associated with making a sale. So For TCLA, if we look at this, we put in the costs that go directly into delivering our training. Actually, though, the biggest cost by far in this section is staff salaries. That's quite common for companies. In our case, if you imagine, this one's a bit messy because some costs for staff go into directly delivering the products that we have, but not all of staff time is related to that. And different industries have different cost of sales, right? So a coffee shop, that might be the cost of coffee beans, the milk, and the takeaway cups. For a restaurant, that could be the ingredients and kitchen staff that are directly preparing the food. What's useful to understand here, and this took me a while to understand, is cost of sales are usually made up of variable costs. That's what we call them. These are basically costs that change based on how much you sell. A great example in our P&L is Stripe fees. So our payments go through a platform called Stripe and they take a cut. The more products we sell, the higher those processing fees are. And so that's a variable cost. Now, when you subtract the cost of sales from the revenue, you get what we call gross profit. And the equation is quite simple. It's gross profit is revenue minus the cost of sales. Now, people get confused by this all the time. You'll hear like net profit and gross profit. It's useful to know that net profit, that's a lot later. That's after we've deducted all the costs of the business. And so gross profit is telling us how much money does the business actually make when we take away the direct costs of making or delivering our product. I can also calculate the gross margin here by dividing my gross profit by my revenue. And that usually is expressed as a percentage. It tells me the percentage of revenue left after the direct costs. So if we take TCLA's case, our gross margin for the 24-25 is about 60%. And that's because our gross profit is about 272,000. And if you divide that by the revenue, you get roughly 60%. After gross profit, we've got administrative costs. That's otherwise known as overheads, operating expenses, or OPEX. And that refers to the costs of running a business after we've taken out those direct costs of what was sold. Now, overheads are usually fixed costs. They remain the same no matter how many more sales that you make. Think of rent or like accountancy or legal fees, subscriptions, recruitment, website management. Those are all part of our many overheads. You'll see one of the big ones as well is our forum cost. That's a fixed cost. It's not related to the producing of our products, but it's a cost that we have every year. Now, our administrative costs for 24-25 amounted to about 155,000. Now, just to catch up to where we are, we've taken out cost of sales away from revenue. That left us with gross profit. Then we took out overheads. Then we get to operating profit. So in 24-25 for us, that was about 116,000. Now, when we're analyzing a business's financial performance, another way of referring to operating profit is EBIT. Bear with me here. This, I know, sounds a bit complex. EBIT just stands for earnings before we've taken out interest and tax. So it shows users of financial statements, like people looking at this, how much profit a business makes before we even get into the financing and the taxes. And I used to hear about terms like EBIT and EBITDA, be like, why do people care about this? One of the biggest reasons is it just makes it easier to compare businesses cleanly. So it's often used in valuations of a business, looking at the performance of a business, or a lender if they want to work out, can this company service the debt? So EBIT is showing the profit generated by the business, but it's saying, let's not look at the interest and the tax and how it impacts that yet. You might have also heard of the term EBITDA, the one I just mentioned. Again, sounds a bit confusing. I used to find it confusing. I think the biggest thing that clicks for me is understanding it in the context of this financial statement. So EBITDA stands for earnings before interest, tax, depreciation, and amortization. So let me explain those two words at the end, depreciation and amortization. All this means is we're going to spread the cost of something rather than expensing it all at once. So depreciation applies to what we call tangible, like physical assets. And then amortization, that's like intangible assets, like a customer list or a patent. So say when I bought my lovely MacBook in April, right? I'm going to get the benefit of that computer for several years. And rather than putting this as one huge cost in April, say £1,500, what I'll do is I'll spread it out over the lifetime. So say like 3 years. And instead of then, if I look at the P&L, seeing that full cost of £1,500, it might be £500 each year. Now, at this point, you might be wondering, why do people use EBITDA over EBIT? And I'll give you another example. Imagine that laptop situation. So in year one, a company buys a laptop for £1,500. And the accounts depreciate it over 3 years. So years 1, 2, and 3, we said it shows a £500 depreciation charge. Now, if we look at year 2, the company is not actually paying cash for the laptop in year 2, but the profit is reduced by that £500 depreciation expense. So that's where the difference comes in. EBIT includes the £500 charge. EBITDA takes it out. In other words, EBITDA is saying, for the purpose of this metric, let's ignore this year's depreciation expense and focus on the earnings before depreciation and amortization. Now, one important thing to note is you won't actually see EBITDA in the profit and loss statement. So I'm looking at Apple's P&L. I don't see a line item that says EBITDA. What I can find is something that closely relates to EBIT and add back in depreciation and amortization. Alternatively, I can look at, okay, I can see net income. I can add back in taxes, interest expenses, and then I'm going to go to the cash flow statement. That's where I can see depreciation and amortization, and that's how I'll get to EBITDA. Now, the point of this again is it just helps, say, an investor looking at a financial statement to compare businesses. So if companies have different depreciation and amortization costs, it's helpful just to strip those out, also strip out the interest and tax, and then compare the finances at that point. Now, after we've done operating profit, the next line you might see is profit before tax. That's basically the profit the business has made before we take out corporation tax. And in some companies, this can be different from operating profit because you might have things like interest sitting in between. Now, the last step, that's where we finally get to net profit. That's once tax has been taken off, so corporation tax in this case. And that's the final profit left over once all the main costs of running the business have been taken into account, including the tax. And that's why people often call it the bottom line. It's the figure right at the bottom of the P&L that tells you, after everything, how much profit has the business actually made. In our case, this hasn't been updated on this statement yet. There were adjustments made by the accountants before filing the accounts. So if I look at the actual filed accounts, the profit before tax was about 87K with 22.8 thousand in tax. And that leaves a net profit of £64,000. So at this point, it's probably useful to know that corporation tax in the UK at the moment is on a sliding scale, depending on how much profit you make. It starts at 19% and then increases. In our case, if we deduct that corporation tax, we have our net profit. If we look at our net profit margin for the year, that was roughly 14.2%. Okay, so we've done the first financial statement, the P&L. And if I take a step back, the main thing I want you to take away is the P&L helps you to understand the financial performance of a business, especially looking at how much money a business makes, how much it spends, and what's left over. And investors and companies use this when evaluating all sorts of different global businesses, depending on its type. And they'll play around with different metrics, right? So what was the revenue growth? What was the gross operating EBITDA or net profit margin? But if I just had to simplify this to one takeaway, I'd say three things matter. Is revenue growing? Are the margins healthy? And how profitable is the business?